Are you an investor looking for premium market opportunities? Presenting premium and exclusive service for investors by Kalkine.
Rare protests rippling across China over Beijing's zero COVID-19 policy may have unleashed a fresh wave of political uncertainty, but could also hasten the reopening of the world's number 2 economy, according to foreign investors on Monday. China's stocks on Monday suffered their worst day in a month, and its currency also took a tumble, while global stocks came under pressure and oil prices slumped more than 3% as protesters made a show of civil disobedience unprecedented since President Xi Jinping assumed power a decade ago. China's markets have had a challenging year, suffering from a mix of political risk aversion in the wake of Russia's invasion of Ukraine in February, as well as worries over its economic growth given stringent COVID curbs and the fallout from its property sector woes. Chinese bond portfolios have posted outflows every month since Russia invaded Ukraine in February, totaling $105.1 billion over 9 months, according to data from the Institute of International Finance. Chinese stock portfolios lost $7.6 billion in October alone, the most since March. On Monday, the offshore yuan weakened against the dollar to 7.24, and the risk-sensitive Aussie dollar, which is strongly tied to Chinese growth, was the worst performing major currency, falling 1.61%. Shares in Apple Incorporated slid down 2.7% as worker unrest at the world's biggest iPhone factory in China stoked fears of a deeper hit to the already constrained production of higher-end phones. Protests against China's strict zero-COVID policy and restrictions on freedoms have spread to at least a dozen cities around the world in a show of solidarity, with rare displays of defiance in China over the weekend. The protests were the strongest public defiance during Xi's political career, according to China analysts. Now that you're up to speed, hit that bell icon and subscribe to stay up to date. I'm Holly Shields for Kalkine Media.